Well, good morning, everybody. This morning, what I want to talk to you all about is high probability trades. High probability trades using weekly options and using vertical spreads. The absolute best way to trade the stock market for consistent returns is to use vertical credit spreads. One of the nice things about credit spreads is you might think that you're bullish about a stock or an ETF, and you'll go ahead and put in a call, let's say, or you buy the stock outright. Well, that stock has to go up for you to make money. And if you have an option, that stock has to not only go up, but it has to go up in the time frame that you have the option for you to make money. With a credit spread, a bullish credit spread, what we would be doing is selling puts. It's called a bull put. Now, the beauty of credit spreads is if you're not exactly right on the direction, if it doesn't go straight up, if it goes sideways or maybe even drops a little, you can still make money. Just the opposite is true. If you see the market's going down, you want to be bearish. You either sell the stock or sell a put. Excuse me, buy a put. We're going to do bear calls. So we're going to be selling calls. It's a bearish strategy. Once again, with a bear call, it doesn't have to go down. It can go sideways and it can go up a little bit and you can still make money. Time is your friend. What I'm going to be talking about today is high probability trades, and we're going to be focusing on the SPX weekly options. My goals are to give you an honest look at why most traders lose and give you an idea of how to flip the script. Market manipulation and poor entry and exit techniques can be avoided when you use credit spreads, especially on the weekly options. You're going to learn high probability short-term income generating trading technique. You can use this right away on both large and small starter accounts. And we're going to talk about how to apply these techniques while leveraging with weekly options, specifically the SPX. Now, as Renee mentioned, I've been trading for 35 plus years. This is how I make my living. I'm a hedge fund manager. I've been a keynote speaker at a number of places. I've written 3 financial books. Currently, I am the founder and head trader at optionsinfinity.com. There are 2 programs that we have at Options Infinity. One, and they're both trading credit spreads. One is the SPX weekly option regression. These are trading the weekly options. The other is Option Pro. We're trading credit spreads here, but we're trading the monthlies here. So this is a little bit more slower, if you will. It's good for people who are working. People that don't want to watch the market all the time. This is a little bit more active. The profitability of both is about the same. Okay, let me give you a trade example. This is an actual example that that I made money on just recently, and so did all my mentees. This happened just last week. This happened on March 13th, which was actually last week. we got in right around here after it had come up to this line. What is this line? This is the regression channel. The regression channel is a very powerful tool, and I have been using this for years. The purple line is the regression line. It is calculated by 50% of the price being above, 50% of the price being below. The green line is the plus or minus 1 standard deviation of the regression point, okay? It's plus or minus 1 standard deviation. About 65% of all prices will be contained within that plus or minus 1 standard deviation. The gold is plus or minus 2 standard deviations. The beauty of this is 95% of all prices will be contained within that channel. Now, occasionally you're going to get outliers. The stock market doesn't know from statistics. However, if you think of this purple line as being a magnet, and the further away it goes, the harder it pulls it back, and sometimes it overshoots, and then it pulls it back. This is the mean. This is the mean. And the SPX always reverts back to the mean. Always reverts back to the mean. Okay. What we did is we put on, when the price was up around the +2, we know that, well, you know, it probably isn't going to go much further. This is like the casing on a hot dog, and here's all the meat in the hot dog, and here's the casing. It very seldom squeezes out of there. Okay, it occasionally will. It occasionally will, but that gives you even a better opportunity to profit using a credit spread. So right around here, right around 230, we entered a 23 March. And what we did is we sold the 2840 call and bought the 2845 call for protection. This is called a bear call. And for that, we received 85 cents worth of credit. 319, when it had come down here, right around here. I could have held on longer, but you know, we already had made a lion's share of the money, so why not get out? At 10:30, we exited because it was down to a nickel of debit. So why hang in there? Why hang in there? We had 4 more days of risk to gain a nickel. No way. As soon as it gets down around that area, I'm out. That's a 94% return. Now, am I using Ninja? No. I use the only thing I use, and I'm not an affiliate with them, is Thinkorswim. I think their platform happens to be one of the best available. I used to calculate this regression channel by hand every night after the market closed. Now with Thinkorswim, you just click a button under standard deviation channel and bloop, it comes up automatically and is updated automatically. Okay, so this gives you a good example of what we're gonna be doing, and let me just talk a little bit more about it, and then we'll come back for another example. I want to show you some of the results. I'm going to show you how you can become a free member on our website, and then how you can go ahead and join if you want to. No obligation today. What I'd like you to do, I would like you to become a free member to learn more about me and learn more about what I do, and become comfortable with me as a trader and a mentor, so that you can become one of my mentees. We were talking about the regression channel, and this is a typical bell-shaped curve, and it shows statistically that plus or minus one standard deviation, 68% of all the data in this point, it's the SPX price, will be contained within that 68%. Then you add another, let's see, 68, you add another 26 on top of there. That's 95% of all data or all SPX price is contained within that region. This regression channel is a very, very powerful tool. It allows you to see when things are overbought and oversold, and to take advantage of that, take advantage of the price reverting back to the mean. Renee mentioned that, I give a lot of credit to Dr. Van Thorp. He has written a book on Trade Your Way to Financial Freedom. I would suggest you all, if you don't have a copy of that, you go on to Amazon and pick it up. It's relatively inexpensive at this point in time. Some of the highlights that he talks about in the book is financial freedom is really a new way to think about money. Most people think they win the money game by having the most money and the most toys. Well, financial freedom means that your money is working for you. It can effectively replace your need to work a 9-to-5 job. Financial freedom. That doesn't mean you won't spend hundreds or even thousands of hours building the foundation for your financial freedom. You got to put the time and effort into this. This strategy that I'm showing you today is something that I've used for many years. I let it be publicly available about a year and a half ago, and I'll show you some of the results. But for me to become a professional, it required me to spend years trying different things, trying different methods, staying within my realm of expertise, keeping things simple, keeping my ego at check, going through losing streaks. Okay, took me a long time to get to the point where I am today. It is possible. It's going to take some work. Financial freedom is possible once you've laid the right foundation. Occasionally, I will get some emails from my mentees, and they'll say, well, I'm going to be retiring in a year, and I want to become a professional trader. And what would you suggest I do? Well, first of all, what I'd suggest you do is don't even think about it until you find a strategy that works, until you find a coach that you're comfortable with, until you spend hundreds of thousands of hours doing it. Then you might think about where can I take this? Okay, I've been doing this for 35 plus years. 35 plus years. I've seen it. I've seen it all. Okay, are weeklies your best path? Let's think about futures. Futures, you can have quick profits because of the very large leverage. However, about 99% of all retail accounts not only lose money, but lose their whole account trading futures and Forex. Think about that. The lure of futures trading is the quick profits. Be very, very careful. The large leverage can bite you in a hurry. Now, stocks or trading stocks is really good for extremely large accounts where you're fine compounding the wealth at a small percent per year. Selling monthly options is good for all size accounts, but it targets 20 to 30% per year. It's a good strategy. Selling monthly options is a good strategy. Selling weekly options is good for both smaller and larger accounts looking to make sizable, consistent income. And that's what we're talking about today. Weekly options. Options, especially weekly options, are rigged with explosive gamma and high premiums. This is by design. So that if you're a buyer of calls and puts, the whole market is against you. You've got high premiums. It's got to make a move, not only a move in the direction, but a big move in the direction in a short period of time. Okay, and the market makers pocket this money by taking it right out of your account during times of rapid price movement at key strike prices, especially if it goes against you. What I want you to do, and what I'm going to talk to you today, is to learn how to join the market makers by selling options, especially on ETFs and indexes. But we never want to sell naked. We always want to have protection. And that's why we talk about vertical spreads, bull puts and bear calls. And you can look at that and you say, well, you know, I can make a lot more money if I just sell this naked. The reality is that because selling something naked is so risky, the market makers will require, or the brokers will require, large margin for you to do that. If you buy a protection on there and set up a vertical spread, the margin shrinks down and the actual percent return is higher than selling naked. By selling options, the hyper-fast time decay of premiums works in your favor. Now, on this next chart, I want to show you this rapid time decay of options, and options are made out of in extrinsic price and intrinsic price. And intrinsic price is just time. It's just the premium that's attached to it because you have time associated with the option. It's that time decay, commonly referred to as theta, that evaporates very, very close to expiration. Look at from 30 days out, this is almost exponential. Almost exponential. The last week, when we're talking about weekly options, the theta decay is way in our favor, and that's what we want to do. We want to have that in our favor. And really what you're doing is, when you're selling options, you're the house in the casino. Okay, you're the house. Traders get lured into buying cheap weekly options, especially exactly this is what the market makers want you to do. They want you to do that. You're about to learn the strategies that not only will allow you to sell with protection, but to do it in times when the probability is in your favor. Okay, I focus on the SPX, the Standard & Poor's 500, the big boy, the SPX. The SPX currently is trading, well, after today, who knows what it's going to be doing, but let me just see here real quick. The SPX down 45, and it's trading right now for $2,660. So it's a big expensive ETF. What's interesting is that over 1/3 of all the SPX volume is now in the weeklies, creating a fantastic opportunity. The big boys, the large funds, the institutions are using SPX to hedge their portfolios. And this makes them very liquid. This liquidity is the key to very tight bid-ask spreads. Also, the fact that it is being traded by the big boys, it's priced in for about a 1% move, but the SPX doesn't move that much. It creates an 85% win ratio in the one standard deviation. Remember when I showed you that chart or the bell-shaped curve, 68% is the plus or minus one standard deviation. With the SPX, it's more like 85%. Okay, so the overbought, oversold concept and the reversion back to the mean is even better with the SPX, because the large funds and institutions are trading this, and they want to keep it close. They want to keep it close. All right, so with knowing that, let me give you another example of this, and this was a trade that happened earlier in the week. Now remember, our trade was happening right around here, and we took it for about 3 days, and we got out with about 94% gain. Here was a trade we did earlier in the week. Notice it's down around the -2. Okay. Now, I usually wait till it makes a higher high, and you'll notice we got in right here when it made a higher high. Once it came down here and hit the -2, I knew it was way overbought. Excuse me, oversold. It was way oversold. Question, and by the way, if you have questions, I've got the question box right up in front of me as I'm going through here. Just go ahead and type them in. I'd be glad to answer them while we're going through. TJ says, why do you prefer the SPX? I went through that because of its liquidity. And why not trade the SPY? The SPY is the E.T.F of the SPX. It's 1/10 the size. So that when you set up a credit spread, you'll notice here to set up a $5 spread here, we got 80 cents. If you were to set up a trade with a bull put on the SPY, it would have been 8 cents. Okay, it's 1/10 the size. So you would have had to do a couple things. One, you could expand this to maybe $10. The other thing you could do is buy more. Well, when you buy more, you're going to pay more commission. And that's why I stay away from the E.T.F, and that's why I focus on the SPX, the big boy. Okay, once it made a new high here, we got in. And I don't want to give you all our secrets here, but you know, you say, well, how do you determine where to? I determine this by the implied volatility, and this is how we set up where to put in the credit spread. This was 3 o'clock on the 17th. We went in with a 16 March, where we sold the 26.50 and bought the 26.50 for protection. Got 80 cents worth of credit. When it came very close to here, I didn't take it all the way to the top, okay? You can see where I got out right here because I saw a little bit of weakness here. Said, you know, let's go ahead and get out of here. It was about 10:30 in the morning. We got out with a 15-cent debit. That's an 81% return. These happen all the time. Once or twice a week. And you say, wow, you know, the market now has been so volatile. Oh, love it. It gives you so many opportunities. There's an opportunity brewing right now. You say, well, you know, the SPX dropped 45 points today. Yep, sure did. I can't wait to put a bull put on there. Not yet. Let's wait till it shows a little bit of strength and a little bit of reversion back to that mean, and then I'm going to jump all over it. The Wall Street jargon makes this strategy appear complicated, but it's not. The good news is you don't need to know anything about options to do these strategies. I can walk you through everything you need to know, and you'll get a 4-part webinar and where I teach you everything that I do here. The nice thing about this is you don't have to watch the market all day. This is a perfect trading strategy for newer traders with small accounts that are looking to grow them quickly. The strategy is also not limited to small accounts. The strategies are safe. There's no naked selling. There's no random assignment of stocks. There's no necessity for it to go in the direction you're looking for. Okay, Robin says, in your example of 80 cents, what's the actual profit? Well, the actual profit was 84%. And now it's up to you, and I'm going to show you a slide, Robin, of how you can determine for your portfolio size how many contracts you should be buying. It's an excellent question. One of the number one reason why people lose in the stock market, especially in options, is they overtrade. As a professional, I will never risk more than 2% of my portfolio. I'm going to show you that. I've got a slide that actually will help you to determine how many contracts can you buy. Okay, how do I trade weekly options? Step one, I place a directional trade, bull put or bear call when the SPX is overbought, oversold. Step two, I exit the profitable trade on Fibonacci extensions, or I exit a loser when the opposite measure move occurs. Yes, indeed, there are losers, and there will be losing streaks. And that's the reason why professionals don't over trade their position. You never know. People say, well, how about just your best trades? I don't know what my best trades are going to be. The market is random. And I know what the rules are, and I set up and execute a trade, but I don't know whether it's going to be a good one or not. So I always trade the same amount. Okay, let's talk about some results. This is a year's worth of on the SPX, and so the regression channel is going to be wider because I've got more data here. What you see here is this is a bull put in red that was placed right here and exited right here. So you take a look at that and you say, well, if I entered here and I exited here, that was a winner, right? You doggone right it was winner. How about this one? Got in here, exited right up here. Was that a winner? Yes, it was. How about here? Got in here, exited here. Was that a winner? Yep. Here, got in here, exited here. Winner? Yep. Winner to the downside? Yep. Winner to the downside? Yep. 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 Since this chart goes back to August 16th, 2017. In that time, there were 21 trades, and we were 20 correct out of 21. Let me let that sink in a little bit, because this is unheard of in the industry. That's a 95.2% win rate. In the NBA, the #1 foul shooter in the NBA is J.J. Redick with the Philadelphia 76ers. He shoots 92.1% of his free throws are good. This is 95.2%. I know professional traders that make a living with a little over 50% winners. This is 95.2% winners. And you say, wow, how much, if it's that accurate, why don't I put my whole account onto these trades? No, that's the way you're going to lose. That's the way you're going to lose. How much was the losing trade, Doug? The losing trade's usually about 50% of the price of the option, or about 40 cents if you've got an 80 cent trade on. Okay, I've got rules that cut it short. I never put in a hard stop, but I do know as soon as I put a trade in where my exit point will be with a loss. Let's go further on these results. This is a 15-month equity curve. Past performances are no guarantee of future results. This is a 15-month equity curve. Very few drawdowns. Oh yeah, we've got losers. We've got losing streaks. Very little bit of drawdown. That is the kind of equity curve you can really be a success with. Now, Rob and I talked to you earlier about you know, how much should you put on this? So I went ahead and I said, okay, for trades, let's say you have a $5,000 portfolio. That's a nice little starter portfolio. You only want to risk 2% per trade. And that's even being a little aggressive. So 2% of $5,000 is $100. You say, well, gee, $100. Well, the average loss, like Doug had asked, is about 50%. So my risk is really 100 divided by 0.5, or $200. Well, $200 is what I'm going to put on each trade for a $5,000 portfolio. The average contract cost is about 80 cents, and that goes back 2.5 years. It's about 80 cents. These are out of the money bear calls, bull puts. So if the average cost in the long run is 80 cents, I've got $200. I can do 3 contracts, three SPX contracts. 3 SPX contracts going to cost me about $200. And I've got a $5,000 portfolio. Am I going to sleep good at night? Absolutely. Absolutely. Question coming in, do you have a demo version? When you sign up for this, you get me teaching you in 4 webinars exactly what I do. Exactly what I do. What broker do you recommend? I can't recommend a broker to you. I cannot do that. I am not a licensed broker. I cannot recommend that. Okay, so we're going along and we're trading 3 contracts. Okay, since I started public in July 13th of 16, 3 contracts per trade. Can you tell I'm excited about this? Return $7,143. That's 147% on a $5,000 portfolio, investing $200 per trade. Past performances are no guarantee of future results. Okay, past performances are no guarantee of future results. Let me just bring up a couple things that my members are saying, because I think it's important to hear what others say here. And GMF said, I paper money traded and did well. First of all, that is a huge statement. Before you embark on anything, you should paper trade it. This has been around for a long time. The SPX will always revert back to the mean. This strategy has been traded for a long time. It's not going away. Take your time to learn it. Learn the idiosyncrasies. Paper trade it. And hopefully you'll go through a couple losers, if not a losing streak, so you see how to handle that. Okay? GMF continues, he says, and last week I sold my first real money trade, a bull put, and according to my by hand figure, I made 59%. Not too bad, not too shabby. Fantastic. Mike H says, I've been making money on the SPX. I started with 1 contract and now I'm up to 10. That's the way to do it. Hopefully he started paper trading and then went to 1 contract. Now he's up to 10. Okay, as your confidence grows, your account grows, you can go right along with it. Sandcar said, when following your rules, I'm 5 for 5, averaging 74% per trade profit. And Pete W said, I'm really enjoying trading the SPX. I started out paper trading, once again, fantastic, in January, and started trading live March 25th. This was last year. Okay. So he spent almost 4 months paper trading this, learning it, and then started real money trading. The results have been fantastic. I've done 8 trades with 4 to 10 contracts. Average gain has been 55 cents per contract with 100% winners. Can't get any better than that. Okay, the reason I bring these up, I want to show you the importance of paper trading. I want to talk to you about going slow. I want to talk to you about setting up so you don't overtrade. These are all very important things to do. Okay, how can you learn more? And I'm going to bring up my website in a second and show you exactly how to do this. But what I would suggest you all do is become a free member. I'm not selling anything today. I'm presenting myself as a professional trader. I've been there, I've done that. I get a big kick out of trading people how to be success. I hammer home the psychology of trading. I want you to go onto the website and become a free member. Once you're a free member, if you like what you hear, if you like what you see, there are 2 credit spread programs that we offer. One is the short term, the trading the SPX solely. The other is Options Pro, and what we do here is we trade the big 5, which is the SPX, the RUT, Amazon, Google, and used to be Priceline, and now it's called Booking Holdings. Those are the only 5 that we focus on. You notice that I like to keep the portfolio small. I like to keep my trading simple. I like to focus on everything, okay? So you can learn more at the website. Well, let's take a peek at the website. Let's just take a peek at the website. All right, here we go. When you come onto the home page, this is the home page, options trading made simple. All you have to do is click on free membership. Free membership, the only thing we require is your name and your email. And once you are a free member, you will have access to all these webinars. Options 101, options leverage, psychology of trading, how I set up my charts, going over a little bit more about trade size, trading psychology, regression channel, Fibonacci's and measured moves, macro MACD, which is an indicator that I developed, money flow and EMA, exponential moving average. All this is for free. All this is for free. If it makes sense, then you can go ahead and join me in one of my 2 programs, either the SPX War, which is exclusively trading the SPX solely, okay? And the other is Options Pro, and that trades the big 5, okay? Now, have a couple more minutes. If anybody else has any more questions, you're welcome, Robin. You're welcome. And somebody typed in nice mustache. Is my mustache on there? Hold on. It is. Pretty funny. Okay. Let's just take a look at what's going on in the market today. And let me see if I can. I want to drop that down, bring this over. All right, this is Thinkorswim, my trading platform, and you'll notice right here that the SPX is down around this area. It's starting to shore up a little bit, but what I'd like to see is a measured move going up and over, and then we probably want to come in and do a bull put that's way out of the money. You can see that the regression channel's on here. I use the Fibonacci's to determine at what level something might go. I think the market might drop all the way down here to the 26.55, which would show support over here. You know, and all of this is, you know, when you sign up for either Options Pro or SPX War, you'll get both of them have a 4-part learning webinars that show you exactly what I'm doing. On Sunday, Tuesday, and Thursday night, I do a video blog that is posted on the website, so you can see what trades we have on, how we're managing them. There is a trade record that is posted on the website, and then every month we get together for a Q&A session that is hosted by me. Okay, couple questions have I've been hit by weekend risk when the market runs away first thing Monday morning. Okay. The thing that the nice thing about vertical spreads is look how far away I am. Look how far away I am. I mean, I've got a lot of cushion in there. It doesn't have to go straight in the direction. It can go sideways and it can go up a little bit. You got a lot of cushion there. You don't have to worry about Monday morning openings that might be, you know, against you. You just don't, because you've got some cushion in there. Question on where I start the Fibonacci levels. The Fibonacci is first of all, you need a measured move. The measured move, what I would behoove you to do is go onto my website, be a free member, and I'll teach you about measured moves. But quickly, a measured move goes from a high to a low to a lower high and then a lower low. That's a measured move. The Fibonacci's start right here, right at the top, come down and up. They're automatically drawn on Thinkorswim, and I'm sure there's a lot of platforms that do that. Is that the ABCD pattern? Absolutely. That's what it is. How much money would it take to make $5,000 a month income? Wow. A better question, Kevin, would be, how big is your portfolio? How much time are you willing to put into learning this? That would be the better question. Then I wouldn't want you to paper trade. Then I would want you to slowly build yourself to the point where you can get to a point where your portfolio is the right size, you've got the confidence, you know what you're doing, and then ask that question. All right? It's possible. It's very possible. It's up to you, Kevin.